let's ask our guest what he thinks about a return to the gold standard. I'm joined by Piers Hillier. He's Chief Investment Officer at Liverpool Victoria Asset Management. Piers, thank you so much for coming in.
Good morning.
I mean, it does seem quite an outrageous comment because we haven't talked about it so much. But do we need to actually, put away Bretton Woods and start from scratch?
It's always good to throw it in the mix, and we're being objective by considering it again. I'm in the camp that says we believe in monetary policy, we believe in the free flow of capital around markets. I mean, China have to admit that if they want to play the game, they have to allow their currency to float as well. America is doing what it has to do to reflate its economy, and I think inflation is the issue that we will be talking about in 2011. But the problem I have with gold is that if I lined up 5 people this morning and asked them, why is gold rising, they give me 5 different answers, and I don't think that's why I'd want it the foundation of a monetary system.
Piers, how difficult is it to actually look at your portfolio today and decide what you're going to do with it? I mean, last week it was all about this QE2. Today it's again concerns about the European debt crisis. What exactly are you looking at?
Well, I think the thing that worries us slightly at the moment is that we're having a lot of regulatory intervention, which is causing people to make what I would say are less rational decisions than they would do otherwise. When we see people buying 100-year government bonds in Mexico at 6.5% yields, we've got to wonder why, when you had a peso crisis in the last 20 years, what were they thinking? When we see short-term yields so low relative to history and a sort of aversion to equity, you've got to go back and understand why is that. We're being forced by regulators to actually effectively invest in lower yielding assets, lower risk assets under Solvency II, and the most recent moves in the UK by Financial Services Authority and in the SEC. And I think that's why you have to understand where there's this massive rush into short-term liquidity. And actually, when we look today, our enthusiasm actually has been for risk assets. I've been on a couple of times this year and talked about equities. I mean, obviously very, very short term they've run, but I think structurally over the coming year, when we see inflation back in the system, and I think interesting, the Bank of England actually admitted over the weekend that the inflation genie was out of the bottle.
Now, Piers, let's just go through your ideal portfolio. You're actually overweight equities, underweight fixed income, overweight property, and underweight cash. Is there anything that you like or dislike in equities that you'd stay away from, for example?
Well, in equities, we've been cautious on Japan really because of currency strength. So if you can hedge the yen, we'd be quite happy to buy Japanese equities. I think they're very cheap. We still think the UK for people in Europe is a very cheap market. Even just on dividend yield, you could even buy yourself some downside put protection and just get the coupon yield. On property, having been very big overweight in the first half of this year, we've started to put some money back in again, and that's really a call against fixed interest, where you get a 6% yield on property. In the UK, you're only getting sort of a 1% yield on a 1-year view. So I'm kind of feeling as you've got some protection. We all know that sort of capital risk in property is there as well, but 5% protection in the short term looks pretty attractive to us.
Piers, thank you so much. Piers Hillier there.